Hello, everyone, and welcome to CPA Academy. My name is Christine, and I'll be your moderator for today's webinar on recovering overpaid sales tax, your guide to reverse sales and use tax audit, sponsored by TriNet. Before we get started, I want to make sure everyone can hear my voice and see the title slide of the presentation on the screen, as well as seeing our lovely presenters today on their webcams. You should be seeing Sunday Vanderver and Maggie Crowley with Leighton. Hello, ladies. And while you're there, I'd love to know where you're tuning in from today. If you could just type me a quick message in your questions box. Just let me know you are good to go on audio and visuals before we get started. All right, I'm getting a check-in from Seattle. Hello, hello. Chicago, New York, Atlanta, San Antonio. All right, I see a couple Texans in here. Welcome, welcome. Tennessee, Georgia, Wisconsin. All right, California. Looks like everyone's good to go so far. If you do experience any technical trouble, please let me know in the questions panel, and I'll make sure to come by and help you out. This is also where you're going to put all of your questions and comments that may come up for our presenters during the webinar. All right, let's go over some housekeeping for credits. Today's webinar qualifies for 1 CPE credit. To get the full credit, you want to make sure you stay logged in for at least 50 minutes of our allotted time and answer the poll questions. We're going to be launching 4 polls total throughout the presentation, and each time a poll is launched, you'll see a poll box take place of where you see the presentation slides, and you'll be able to select your answer and submit your vote. To earn full credit, you want to make sure to answer at least 3 out of the 4 polls. Once the webinar is over, we'll make sure to process your CPE credit, and that will be available in your CPA Academy accounts within 24 hours. You can also find today's handouts on your GoToWebinar side panel, and they are located under the handouts box. If you have any issues downloading the handouts, please let me know in the questions panel, and I'm happy to send it over to you. All right, that's it from me for now. Let me step out of the way and turn it over to today's presenters, Sunday and Maggie with Leighton. Welcome, ladies. I turn it over to you.
Thank you excuse me. Thank you so much, Christine, and thank you CPA Academy for having us. And a very special thank you to TriNet, our partner, for letting us take the floor today to share with you guys all there is to know about recovering overpaid sales tax for your clients. So I hope everybody is ready for a fun-filled hour learning about something maybe you have no knowledge about, or maybe you think you're an expert and you're going to learn a little bit more. So I am Maggie Crowley, and I am the head of strategic development here at Leighton, where Sunday and I both work. My responsibility is to partner with a number of CPAs in several different sectors and niche industries and help them provide a full service to their clients and allow us to take on some of that more niche tax credit work, like reverse sales and use tax audits. And I'll let, of course, Sunday introduce herself.
Hi, yes, my name is Sunday Vanderver. I'm the head of U.S. Sales and Use Tax at Leighton. To give you a little bit of background on myself, I'm a tax attorney. I have a JD and an LLM in taxation. I've always practiced in the state and local tax law. I'm at a major international law firm, at Big Four accounting firms, and now with Leighton. So it's very nice to be here with all of you today. Thank you so much for joining. We appreciate you spending the hour with us.
Thank you. So today, the plan is to cover the fundamentals of a reverse sales and use tax audit, how to identify qualified clients, and then learn how your client can recover overpaid funds. And just to give you guys a brief overview about Leighton and why you're tuning into these people today and getting course credit from our firm. We are a global consulting firm, and our job and our primary focus is to consult clients and partners on niche tax credits. Our core product is the research and development tax credit, and then the reverse sales and use tax audits is a additional core competency that we have. We've got offices in 12 different countries, and we have approximately 26,000 clients. Last year, actually during COVID, we were able to source government and funding that yield the amount of $1.5 billion. So the work that we are doing can truly make an impact. And we want to share that with you guys today, so you can hopefully do the same thing for your clients and identify some savings. So without further ado, let's get into it.
All right, thank you so much, Maggie, for giving an introduction for our firm as well. So the first thing I wanted to start out is getting a little bit of background on you guys, on who's in the audience listening and what you're working on. So we'll start out with our first poll question for today. Do you provide sales and use tax consulting services to your clients? And we'll give you a minute to answer.
Perfect. Thank you, Sunday. We have launched poll question number 1, so you should see that up on your screens. If you do not, please let me know in that questions box. And just like Sunday said, we're going to keep this open for another 30 seconds or so. All right, thank you everybody for voting on poll question number 1. We're going to start closing this down in a couple seconds here, but looking at the results, it looks like 57% said no and 43% said yes. Closing this down in 3, 2, and 1. Back over to you, ladies.
Okay, great. That gives a good idea, kind of a mixed crowd here. Some of you that do give information, some of you that don't. For those of you that do not provide sales and use tax consulting services, I wanted to give an overview and a little bit of explanation about how complicated sales and use tax is and why this is an issue for many companies, regardless of the size of company. It can be from a very small business up to Fortune 500. It's such a complicated process because of the way sales and use tax is structured in the US that there's plenty of room for error. And that's why we do these reverse sales and use tax audit engagements, to help our clients make sure they're only paying the amount of tax that's due and not overpaying. So 45 states impose a sales tax. Most states impose their sales tax at the state level. Alaska is an exception to that. They only impose it at the local level. A lot of states also allow local levels to tack on an extra rate. So for example, I'm currently in New York State for the time being. We've got our state rate of 4%, and then we have the 8.875% at the highest rate in New York City, where I am. It's an entity-based tax, so there's no combined return filings, none of those concepts, that consolidated returns that are used to on the income tax side. It's entity by entity basis. It generally applies to your sales of tangible personal property and then some services. So the burden's on the retailer to collect that tax, and the basis of the tax is usually on the gross receipts. There are some, because it is so decentralized, with each state having their own statutes that talk about what exemptions exist when it comes to tangible personal property, and also which services may or may not be subject to sales tax. There was a movement among states to try and streamline this, to make it a little bit easier for burdens, because you can imagine the compliance burden that businesses have, particularly smaller ones that sell online, and trying to comply with each of these different state laws. So you may have heard of the Streamlined Sales and Use Tax Agreement. Of the 45 states that impose a sales and use tax, about 23 are full members of that. But even then, that's only half the states that are sort of subscribing to sign on to enacting the same types of laws, same types of exemptions, and then things still vary within that. So to give you an idea of how long states have been trying to streamline this process and get some kind of uniformity, that movement started back in 2000, so 21 years ago, still trying to get some uniformity amongst the states to maybe make this process a little bit easier. So the basic presumption is that all sales of tangible personal property are subject to sales and use tax unless they're specifically exempt. To give you some ideas of what qualifies as tangible personal property and what doesn't, put together a little chart here. It seems obvious, right? When you think about sales tax, you go into a store, you buy something, they ring you up, you pay for it, and that's it. That's the way most of us tend to think in terms of sales tax, but it's actually a lot more complicated than that. Even amongst the items that I have listed as tangible personal property, I look at food products, and automatically as a sales tax practitioner, it comes to mind, well, okay, is that prepared food or not prepared food? Because some states, things in the grocery store, if you go in and buy a tomato, you may not pay sales tax, but if you buy a prepared meatball and spaghetti dish, then there may be sales tax charged on it, depending on what that particular state's rules are. It really does get that tricky. And one of my favorite examples to give to people is that in some states, you've literally had discussions and questions about whether a miniature marshmallow qualifies as candy or food. This is how granular and how specific it gets, and that's why it's so complicated. For things that are not considered tangible personal property, You can look at the right side, transfer of artwork via email, real property, security, sales of gift certificates. That seems like it may be simple too, right? That's something that's not tangible personal property. It's not, and we'll touch on that a little bit more in services when we talk about cloud computing. One thing I'd like to give you guys is an example of how sales tax laws have changed and evolved over the years that you're all CPAs. You think about TurboTax, and we used to use that product and get the hard disk in the mail, and now that's not the case at all. Use everything online. That's an example where tangible personal property used to be pretty simple, looking at a CD, a disk, or something that you were given, right? But now that we're using a lot of things online, the statutes haven't necessarily changed and the regulations provided by states to keep up with that. So we're still applying some pretty old, archaic definitions to products that have evolved a lot. And that's where a lot of this complication, a lot of this confusion, and different issues end up happening in the sales and use tax world. Another example of exemptions within just tangible personal property, some states will have an exemption for clothes under a certain dollar amount. They're just all over the board. And so that's what this is meant to just remind you, that sales and use tax is really much more complicated than just walking into the store, buying something, paying the tax, and walking out. So unlike sales of tangible personal property, where the item is automatically assumed to be taxed unless it's specifically stated as exempt, services are the opposite. In states that impose a sales tax, services are not presumed taxable unless they're specifically stated to be taxable. Because I am in New York for the time being, I am using New York State examples, looking at our utility services, installation services, protective and detective, information, telecommunications. And then I do like to touch again on cloud computing. When you look at software as a service, platform as a service, infrastructure as a service, states are all over the board in that. About half the states will impose some type of tax on software as a service, sales tax, other states do not. That is one of those areas that's always quickly evolving, and it becomes even more interesting and even more confusing when you think about how to actually source those sales when states are destination-based sources or not destination-based sources. So it's, again, becomes very, very tricky, very complicated. You also have the issue of what happens if you're selling something that is taxable with something that is not taxable. For example, if you have a non-taxable service that's bundled with a piece of tangible personal property that gets transferred. The example I like to give there is if you're a dentist and you provide dental services to your client, generally you're not your patient, generally not taxable in most states. But what if you also give them a free tube of toothpaste? Does that suddenly taint the whole transaction? Not necessarily. Most states, and I'll cite New Jersey's example, give you a definition of what a bundled transaction is when you have something that is subject to tax and something that is not subject to tax, but that are all together in the same transaction. New Jersey uses a test called the true object test. That's a pretty similar test that is outlined in different states. New Jersey is a streamlined state, so a lot of states do tend to use this true object test definition. And you have a bundled transaction when you have two things that are distinct and identifiable products that are sold for a non-itemized price. So chances are, when you get that bill from the dentist, you're not going to have a separate charge for your toothpaste. He's going to consider that part of the service, et cetera. There's not going to be a separate line item broken out on your invoice. So the question is, well, when does something become too much where it does make the whole thing taxable? Most of these states that apply that true object test have a de minimis threshold. For example, less than 10% of the price. It's de minimis, doesn't make everything that happened in the entire transaction taxable. That's where you get into issues of really needing to make sure that you get a sales tax specialist to look at your clients' practices and how they're breaking down their invoices. Because if it wasn't de minimis, if it was a much bigger part of the purchase, then that could make everything subject to sales tax unless you break things out on separate line items. And when state auditors come in and look at this, that's something they always look at. Is there any way that we can make sure that we capture the entire perhaps non-taxable service as taxable because there was some incidental amount of property? Did it exceed that particular state's threshold? So that's another thing to always think about is, is it going to be tangible personal property and a service together? If so, we need to look at the value of that property. We need to look at the state's test. We need to look at whether it should be broken out on the invoice and how we should address this. So we often hear, when you hear the phrase sales tax, you often hear use tax as well. And use tax is something that people tend to be not quite as familiar with as they are with sales tax. It's complementary to the sales tax. In states that have a sales tax, use tax is going to be the same rate as the sales tax that's imposed. Use tax is going to be due on items that your client purchases where they do not pay sales tax, or if they pay a lower rate of tax and then bring it back into the state where they're operating for use. So generally, use tax is going to be on things that you purchase out of state or from a foreign vendor that may not charge sales tax. But when you're bringing those physical items of tangible personal property back into the state, you have an obligation to accrue use tax if it's a lower rate or if you didn't pay any sales tax on that. An example that I have with a client that I dealt with several years ago purchased a lot of things overseas from foreign vendors, had all these fixtures, display cabinets, things shipped back to the US that were used in a bunch of different states, and they would have been subject to sales tax in every state. Client did not accrue use tax on any of those. Then you get audited by New York State. New York State comes in, why didn't you accrue the use tax? And so that becomes an issue because that property was used in New York State. Of course, we had to look at, where even though every purchase was billed in New York State, it all wasn't billed at the same sales tax rate. We looked at where each piece actually was being used, provided documentation, but it became a very long, complicated process that really complicated the audit a lot because the records weren't as accurate as they could have been. And so that's a situation where having good use tax records is extremely important. Another pitfall that I've seen for clients is that use tax is also due on items that are purchased for resale that a company uses for its own use. I had a major cosmetics company that was a client of mine for several years. They would pull things out of their inventory to make a tester for a client to use or to showcase the products. Had lots of gifts, lots of free samples and things like that. Did not pay any sales tax on it when they got them. They were produced overseas. They did not accrue the use tax, and then were dinged pretty badly on audit for not making sure to take care of those amounts and make sure that they were paid, because they weren't going to be items that were ultimately resold anymore, where they would collect the tax from the consumer. They were things that were being used directly by the company or given away, and that's when the sales tax obligation would fall back on the company to report that as part of their use tax. Fun fact: individuals are supposed to report use tax due on individual income tax returns. I'm sure many of you prepare those, and you've seen that line item on different things. There was actually a pretty famous case back in 2009, the Town Fair Tire case, where when you live in the Northeast, as you know, our states are pretty close together, and some have. New Hampshire does not have a sales tax, Massachusetts does. There's a company called Town Fair Tire where the issue was the state of Massachusetts was saying, wait a minute, you need to be collecting tax on these, because if someone comes in and purchases tires in New Hampshire, but they have a Massachusetts license, the vendor should be collecting tax and making sure that that money goes back to the state of Massachusetts. Well, the courts held, no, that burden is not on the vendor, because there was no way that that company could have known exactly where those tires would be used, that it wasn't enough evidence of just having an address, just having a driver's license, that burden was going to be on the individual to report that on their returns and not on the company to have to report. Okay. So with all this question about everything that is, subject to tax, what's not subject to tax, and all the different pitfalls that we can run into in different spots, where are businesses actually required to file sales and use tax? It used to be pretty simple. I'll say simple. Sales tax is never simple. But from 1992 until 2018, the standard was physical presence. There had to be employees, property, people in the state, some kind of sufficient connection that would create nexus through physical presence in the actual state. But that's the term we often use in sales and use tax, is nexus, which basically just means sufficient connections that gives the taxing jurisdiction the right to subject the business to the tax. So for some businesses, it's fairly easy. If you say you own a retail store, you're in California, all your sales are from the store in California, you do no online sales, where you think you file? California. But that's not always the case for especially in today's world where you have so many online retailers, and certainly since the start of the pandemic, we've seen a lot of smaller businesses go to online platforms and things like that to try to reach a wider audience, especially while their businesses were shut down. Well, in 2018, the court moved away from a physical presence standard in the South Dakota versus Wayfair case, which dropped the physical presence requirement and allows economic nexus through a certain dollar threshold or through a certain number of transactions. The statute in that case was the one that South Dakota had adopted, which said, okay, you're going to have economic nexus if you have more than $100,000 in in-state sales into South Dakota or more than 200 transactions into South Dakota. And that would be enough to require an out-of-state seller to collect and remit sales taxes on transactions in the state. And again, that's the phrase we use, economic nexus. For those of you that do income tax, that's not a foreign concept. The question of economic nexus in income tax has been around much longer. We've seen those statutes in different states, California, Connecticut, for example, that always had these, that implemented after 2008, a lot of these economic nexus standards. However, it is really new. It is new since 2018 for sales tax. Dropping that fiscal presence requirement was quite a big deal. Part of the reason for this, we all know the big online retailers, right, that are operating all across the country, making sales into different states, and that we're not collecting sales tax. And states want a piece of pie. They see that so many dollars and things are being targeted and collected from purchasers in their state, but they weren't getting any of the revenue. And so that was part of the push that brought on the advancing of the South Dakota versus Wafer decision and how that ended up making it. But some states, such as New York, for example, had taken the position since 2008, 2009 that if you have an affiliate in the state, if you have a market facilitator, someone, a cookie nexus, you may have heard all those terms. It was always kind of moving towards the standard, but it wasn't official until 2018. And so suddenly at that point, a lot of smaller retailers, if you think about it, $100,000 is not that large of a threshold in any state, that suddenly now have an obligation to file in states where they've never had anything but sales into. And that becomes very, very complicated, especially because they're not all the same. Some of the larger states, California, for example, that threshold is $500,000, but it's $100,000 in almost all of the other states. And so it becomes an issue of having to track that, making sure, when you hit that threshold, when do you need to file, when do you need to start collecting? And it's a big burden for a lot of smaller sellers. Importantly, all 45 states that have sales tax have now enacted economic nexus laws for purposes. It's Wayfair. And so the last two were pretty recent. They were this year, both Florida and Missouri, but they've enacted theirs now. Another thing I would like to point out as well that you may or may not think about, I'm not sure how many of you have foreign clients, but there's no protection under a treaty. For example, under income tax purposes, a client that's a foreign client doing business in the US may have maybe in a country where there's a treaty with the federal government, so there's no federal tax filing requirement, maybe the state conforms and there's no state income tax filing requirement. Well, none of those apply to sales and use tax. I've seen instances and worked with companies that produced events and things, an Australian company that did different events around the United States for 2 or 3 weeks at a time, moving a lot of equipment around, making lots of sales, not collecting tax on that, have some issues and trying to get into compliance, and we would do voluntary disclosure agreements and other things to be able to bring them into compliance so that they didn't have additional exposure going forward. So that's one thing to definitely think about, is that treaty protection does not apply for sales and use tax purposes. Not to throw another wrench in, but to make it even more complicated, some states there are 12 states that are origin-based states for sourcing, meaning which sales tax rate applies, correct? Like that's one of the biggest issue that our clients face. Okay, we know we have nexus, we've hit that threshold. What rate are we actually applying? You have to go one step further and think about, okay, well, what is the state's requirement? In a state like Alabama, where the state uses origin sourcing, you base the tax on where the seller is located. Some states use destination sourcing, and that's where the buyer takes possession of the items. Each state also has a hierarchy if you don't have that exact information, how you apply. So it becomes a really detailed, minute process. And again, that sort of sets you up for how you can see how there are so many different types of errors that can be made in the sales and use tax collection process for vendors selling to businesses, for business selling taxable items and taxable services. There's just a lot of room for error because of the administrative burden of it. And quite frankly, most companies just do not have the manpower or the ability to verify each transaction as it happens. And that's where there's plenty of room for error. Okay, with that, that's going to bring us to our next polling question. And that is, how many states now impose nexus for sales and use tax purposes? Economic nexus, that is, for sales and use tax purposes. And we'll give you a minute to answer.
Thank you, Sunday. Poll question number 2 is up on everybody's screen. All right, thank you everyone for voting so quickly on poll question number 2. We're going to start closing this down in 3, 2, and 1. And sharing the results, it looks like 68% said every state that has a sales tax, 23% said 25, 6% said 15, and 3% said 0. Back to you. Oh, Sunday, I think you might be mute.
You know, you'd think after a year of this, we would get used to muting and unmuting ourselves, right? But
Right there with
still,
you.
still happens. Well, the correct answer is that every state that imposes a sales tax now has that economic nexus standard for sales tax purposes. And that's what, again, has made things so become even murkier, more complicated in the sales tax world since 2018. So one thing we'd like to talk to you today is about the process for performing a reverse sales and use tax audit. Normally, when our clients hear the word audit, you get scared, correct? Because you think about the state from a tax perspective, you think about the state coming in, looking at your books, identifying a liability, and it's just a process that can be a huge headache. Well, that doesn't necessarily have to be the case, particularly if you are having your provider do a reverse sales and use tax audit for you throughout the years to make sure that you're doing everything correctly on the purchasing side. We went over, in depth how complex sales and use tax can be. So again, you can see how vendors may inadvertently apply the incorrect sales tax to a purchase. And similarly, companies that self-accrue use tax also make mistakes. I like to give examples again, saying that it really doesn't matter on the company size. There's always room for error. I've worked for some large utility companies in the Northeast that had full sales tax teams, full AP departments, people that were reviewing things, and because they took a conservative approach, ended up accruing use tax for materials that were being used all over the country at one central billing location that was a much higher use tax rate than other places. We'll go through a case study a little bit later in the presentation that sort of walks through how those types of things happen. But the point was that no matter how sophisticated the team is, it really is good to have someone that specializes in sales and use tax come in and take a look at it. So we do call it a reverse sales and use tax audit because we're doing exactly the opposite from what the state would do. The state will come in, identify your liabilities. When Layton performs a reverse sales and use tax audit, we look for any chances where you've overpaid. Now, I'd like to stress, this doesn't look at any of the company's sales. It doesn't look at any of their sales, their services, and whether they should be collecting and remitting tax. This particular process looks at the purchases that the company has made over the past few years to determine where they may have paid too much sales tax or accrued too much use tax. Again, that's just looking at the purchasing data, and typically that look back period tends to be about 3 to 4 years, depending on what that particular state's statute of limitation is. We talked about all the states that impose a sales tax, and we touched a little bit on the fact that local jurisdictions can also tack on a sales tax to a state sales tax, which results in more than 7,500 different taxing jurisdictions with varying rates in the US. It just becomes a very difficult process. And for example, even within a particular state, such as New York, it gets even trickier when you don't even have uniformity between the state and city for what is taxable and what's not taxable. For example, you got your New York state rate at 4%. In New York City, it's 8.875%, but there are actually several services in New York City that are subject to sales tax, but that are not subject to sales tax at the state level. For example, beautician services, health fitness clubs memberships, those types of things are subject to sales tax in New York City. And so that's another area where you have to, again, get really granular, look at those details, make sure that, that the correct tax is being paid and collected. Okay, we'll go to our next polling question. Number 3, how many changes would you guess in sales and use tax rates that have occurred since January 1st, 2021?
Poll question number 3 is up on everybody's screen. Thirty seconds left. All right, we're going to start closing down poll question number 3 in 3, 2, and 1. And looks like the leading answer here was more than 100.
That is correct. There have been more than 150 sales tax rate changes. I've looked at a couple today, actually, when I was reading my morning updates, that these change frequently. Sometimes it's an increase, sometimes it's a decrease. And these particular laws, you'll see gradual changes where there'll be a certain, 6% in effect until 2022, then it jumps to 6.5%, sometimes a decrease. But the point is, these change all the time, particularly when you think about the localities where those local jurisdictions can make their own changes as they see fit to do so. So how do these errors actually occur? What are we talking about when we say, how do you possibly end up paying too much sales tax? Well, errors in the sales tax are generally due to just misapplying these tax laws. For example, a lot of times you'll see something that may be exempt that a vendor wasn't aware of is exempt into the state where they're selling to, and so they inadvertently collect sales tax. The client pays it when that tax wasn't actually due. It really gets complicated when you deal with companies that are operating across state lines. That's where you start to see a lot of these errors take place, but it does happen within the same state. When you have a place such as California that has lots of district taxes, you have Colorado home rule jurisdictions, there are lots of different ways that those errors can happen. So you can't just look at the state level, you need to also look at the local level, because the dollars can really begin to add up there as well. Another example, again, applying the incorrect rate, such as my utility client, where they applied the highest jurisdiction rate for all this equipment that was actually going to different places all over the country. And the use tax that was all purchased from a foreign vendor, they accrued their use tax, but it was at the highest rate. We did a lot of review, making sure where everything actually went. We're able to get them a pretty sizable refund, over a couple $1 million back in taxes over the years. One thing I'd like to stress is that if you choose to go with a service provider such as Layton, there's no financial risk. All this type of work is done on a contingent fee basis, meaning if there is no overtaxed amount paid, if there's no refund, no credit, nothing identified, then nothing is due. But it's a good time to take a look at the process. And importantly, you can also see, even though we're just looking at expense accounts, it's also a good time where it's sort of functions as a process review as well, where we'd be able to spot, not necessarily calculate, but spot where there are errors in collecting sales tax too, through the process of examining the books and records while we're looking for overpayment. We might also notice where there was underpayments and things. So that's a good way to figure out if there's anything due, but also, do you have any exposure? Does your client have anything sitting out there that you haven't necessarily accounted for that may be due to a state that could leave them on the hook, needing to pay something else if they were to get audited by that state? So what kind of clients? Who's a good client to target for this? Again, there are almost all companies. There are a lot of different things, but I like to get these benchmarks because these are the ones that we've seen the biggest return come back for the client, and really who should consider doing a reverse sales and use tax audit. The best client is a client that has already been selected for a state tax audit, particularly a sales tax audit. And what's great is that any overpayments that are found during that time, well, for one, the client's already pulling all the records for that period. They're pulling everything on the sales side. They're also having to pull a lot on the expense side so that the auditor can look at their purchases and make sure they paid sales tax there. So it's often examination of the same records, but the state auditor is not going to necessarily point out, hey, you overpaid on this. That's not going to happen. So if you engage a firm to do a reverse sales and use audit at the same time, then any of those overpayments identified, they can work with the state to have those applied directly to offset any potential assessment. I've seen this result in a no change audit several times, meaning they go through the audit process. Okay, well, we found enough credits. This takes care of that. Nothing is due. Or even where there were so many overpayments that it offset everything that was potentially due, and then the client had a credit on their account, or they were able to get a refund back for those amounts. So that's a great time to do that because the client is already engaged in pulling those records, pulling those resources, and being able to go through that process once. However, that's not the only time that you should consider doing that. Particularly if you identify where a client is overpaying particular vendors, you obviously don't want to pay more than you have to when you're doing that. So it's a good time to do this review every 3 to 4 years. We always say companies operating across multiple states are excellent targets. In terms of revenue, there's really not a particular benchmark, but I usually say above 5 million in revenue is where you start seeing more significant errors, just because they're going to have the more revenue, the more purchasing power, most likely, and that's where you start to see those types of things. And then I always like to look at companies that are places that make sales for resale. The reason that those are good targets is because if a company is selling things for resale, they may not have as much exposure potentially on what they're selling, because that, if it's a sale for resale, most states it's going to be exempt as long as you're maintaining exemption certificates and that kind of thing. And so there's, I don't want to say there's going to be no exposure, but it's unlikely that there is much exposure to be discovered should the state, want to audit them if they have looked at this same particular time period. So I always say they're great because there's really not as much exposure risk on what they're doing, and there may be a big benefit on what they're purchasing. The first thing I always like to ask the client is, do you file sales and use tax returns? That's what's important. That's what turns the clock on for the statute of limitations, as you know. So if they are filing those returns, then that's one of the first places that you start is looking at that. Do you make purchases from out-of-state vendors? That's another good indicator. Have you reviewed the accuracy of your sales tax process in the last 4 years? I'm always surprised that a lot of clients really have no process in place to look at their sales tax process. But again, it's often due to manpower. It's not due to willful neglect or anything like that. It's just the client doesn't have enough manpower to actually go through and really invest in an AP function that can review all those invoices, review all those purchases, and make sure that things are going according to plan. So those are some financial benchmarks. What about specific industry targets? List a few here. Manufacturers, always great when it comes to doing a reverse sales and use tax audit. If they're manufacturing, they have very big purchasing power. But the more purchases that you do, the more chance there is that you're overpaying some vendor. There are often exemptions for machinery and equipment. Another area that we look at is R&D equipment. A lot of times that may be a reduced rate or no sales tax due on some of those items that are purchased by some of that equipment. And then the items and material manufactured are usually exempt. So they're sale for resale, so there's usually not as much exposure. So manufacturers are going to be probably the best target that we tend to see in the reverse sales and use tax audit process. Agricultural companies are also great. Lots of exemptions for their equipment and specific products. Grocery stores and retailers, again, special industry rules. I've mentioned that prepared food, not prepared designation. So a lot of things are not going to be subject to sales tax, but they could be purchasing things from vendors that are overcharging them. Public utilities are great. These companies tend to be very conservative because they're so heavily regulated that's where you may find a big benefit, like we did for my client when I was at a previous firm. Also, it's great to look at the hospital, medical, and dental industries. Medical exemption equipments are available in many states, lots of medicine, things like that. These rules are very, very different when you get down to, is a cotton swab subject to sales tax, as a catheter too. It gets very, very granular, very, very specific. But companies in the medical field often do not have enough personnel that have the time and expertise to really look at these. So a lot of those clients may be really missing out on some big benefits and some big refunds that they could be getting when they're purchasing something that sales tax shouldn't have been collected on. So that's another great industry to take some time and target. So what does this process actually do? What does Layton do if we help you and your client do a reverse sales and use tax audit of their business? First of all, we have to understand exactly where the business is located, where they're currently paying sales and use tax, where they're filing, look at their specific exemptions that would be applicable. And then the next thing we do is we identify all the expense accounts. We pull a chart of accounts document, look at that, look at the transaction level detail, identify any potential issues of overpayment. It does get granular where we do request some sampling of invoices to look at, and that's because in order to substantiate a refund claim with a state is going to want at a minimum a sampling of invoices. But what I like to explain to clients is this process is not super intensive on the client side. It's more of a data dump for us to look through and then identify questions and things to ask them about. We try to do it as efficiently as possible in terms of having an initial conversation, talking through the steps of the business, getting the documentation from them, getting the data, whether it be someone in their AP group that pulls it, or if they have a bookkeeper or an IT person, we determine who exactly we need to speak to, make sure we get the right documentation, and then it's a review on our part, another follow-up conversation with some questions to make sure that we're including everything that we can in order to get the biggest refund for the client. At that point, we would determine, after looking at those invoices, after looking at those transactions, to see if there was in fact any overpayment that was made. And then we prepare a refund report for the client and assist them with recovering overpaid sales and use tax. Now, most of the time, that actual recovery comes from the state. However, there are some states that require you to initially go back to your vendors and speak to them first. So it would be dependent upon each state, and then to help walk them through the process of actually receiving that, whether it be in the form of a credit or if it's a refund from the state or from their vendor. So that's kind of how the process works. I do want to walk you through a couple of examples that show you some dollar value based on different size clients, so you can get an idea of potential tax savings for clients. We have a lot of dental clients, and so the issue here was that wasn't even any of the dental equipment or dental supplies that caused a refund to be triggered for this client. It was an employee uniform issue. So they were buying from a vendor out of state that was charging them sales tax on employee uniforms, but those actually weren't subject to sales tax. There was also software that was being purchased, but it was being used in lower tax jurisdictions, but being billed to a higher billed to an address with a much higher rate. So the turnaround time took around 5 months. It was a $12,000 total credit amount that was identified. We only looked at 1 year of purchasing. That was all that was relevant for that particular client, and they were able to get back $12,000. Of that, Layton is paid in a contingency fee. And so that's a percentage that we work with the client to determine. And again, if we hadn't found anything, had not been able to recover anything, then there would have been nothing due to us at all. Again, turning back to manufacturers, often a great one. This one took around 11 months to complete. There were about 500 employees or more over 14 states. We looked at 3 years, and over the 3 years identified $1 million, around approximately $1 million that had been overpaid. Here, the company was paying sales tax on manufacturing equipment that actually qualified, some of that equipment qualified for an exemption. And then there were also, again, an issue where they were being charged the incorrect rate for items based on where they were actually going. And so that was it took some time, a lot of detail, a lot of documentation for us. We were able to put it together, successfully defend that, and get that money back for the client. One thing I didn't mention earlier that I do want to mention now, you'll see in this, the stakeholder box, the responsible person. If you work in sales and use tax, you're very familiar with this. So I'm sure at least half of you that do this type of work know exactly what the responsible person is. But there's one person that's registered for that has to be the person listed for every business who is actually personally responsible, personally liable for sales tax in these states if that's not collected by the business. And so that's why it's really important, in terms of income tax and then corporate tax, you hear concepts such as piercing the corporate veil, things like that. There's reasons that you can't necessarily go directly to an individual owner to hold them personally liable for things of the business. That's why we have different business structures and such. But in sales tax, that's not the case. There's somebody literally listed as a responsible person. I had a client in New York State where the CFO was listed as the responsible person, and before there was an asset sale, selling off some different things in the business, he wanted to make sure everything was in order, totally ready to go, that everything was done correctly, because he could be personally liable if everything in that sale wasn't taken care of. And then also looking at what they're purchasing and they're selling and everything had been happening over the past few years. Did we accrue the right amount of use tax? Did we do that? To make sure that he wasn't personally on the hook for that. So that's another reason to speak to your clients about this and just find out who is the responsible person. With that, this brings us to our last polling question for the day. Do you regularly consult with your clients on their purchasing processes or their procedures? And I just asked this because I'm curious to get an idea, especially since Wayfair, how many businesses are really starting to take a look at this and see if there may be any errors or any overpaid amounts potentially due to them. So we'll give you a minute to answer.
Sunday, I got a question here from an attendee asking, is there a list by state for economic nexus to use as a quick reference?
Yes, those things are available through different research engines. So the short answer to that is yes. There is a way to get that.
Fantastic. And then another question here from Jacob. He's asking, how do you price your services to clients?
So for reverse sales and use tax services, the reverse sales and use tax audit process, we typically charge between 30 to 35% of what is actually recovered. So for example, if we went in, with a certain dollar amount to a state and then that amount got reduced, our fee would be based off of what the client actually recovered in terms of the tax benefit, whether they choose to have that as a credit on their account or if they're able to actually get a refund back from the state. It's generally 30 to 35% in the US, and that's consistent amongst different competitors and things that also use this, that also offer this particular service. Now that said, reverse sales and use tax is not the only service that Layton offers. We also do audit representation for clients that are undergoing sales and use tax audits. We're happy to perform nexus studies where we help clients determine where exactly they should be filing. We can do general consulting, looking at taxability of products and services, process reviews, things like that. And those are done on an hourly rate basis, generally around $400 or $425 an hour.
Thank you, Sunday. And with that, we've closed down the last poll question, and just reading out the results, it says 68% said no and 32% said yes.
I'm surprised at 32%. That's more than I would think. So I'm glad to see that you're starting to look at this. So please feel free to reach out to us with any questions. And I know Maggie's going to give you a little bit more information on why it's important to go with a specialist, and then we'll be wrapping up for the day.
Thank you, Sunday. I hope everybody enjoyed the presentation. I know it's definitely interesting to me how many details are involved in managing that aspect of your business, which leads me to explain why we find it really helpful to choose a specialist when thinking about taking on these ancillary products, pretty time consuming. We at Layton, we have a great group made up of tax attorneys like Sunday herself, financial analysts, experts, and then we also have a team of sector experts. So we have doctors, scientists, engineers, so on and so forth, who will approach our tax credit studies with dual expertise. So not only do you have it from the financial side, but also from the side of understanding what our clients do. So that allows us to implement a claiming process, whether it's for the R&D tax credit or for the reverse sales and use tax audits or for the sales and use tax consulting. And we can put a process in place to help them year over year claim this properly and appropriately and use it as a true tax strategy. And we do all the heavy lifting. So, and then we're able to uncover all the overpaid sales tax and amounts to ensure you're claiming what you're eligible for, bringing, making this a valuable experience for your clients. And I think they tend to really be happy having a specialist make sure that you're doing it correctly. We also provide audit support for all the work that we provide. So that's an extra bit of relief that you can go forward with as you're encouraging clients to take on some of these niche tax credits. And then we're able to document some of the minor process improvements often overlooked within niche industries. I think that literally is like every part of a sales and use tax audit. It's all about what has been overlooked. And then, as Sunday said, and as many of you are aware, there are ever-changing rules to the tax code, whether it's for R&D or for sales and use. So it's our job to keep on top of it, and we can share that information with you guys instead of you guys having to stay on top of it. So we would really love to answer some questions. If you've got them, share with you the other services that we provide. We will send out a link so you can schedule some time to speak with us, just to get to know us a little bit more, and perhaps learn about our partnership with TriNet, the services we offer, and we really look forward to doing that. So we'll send an email with a link to schedule a meeting, but if you'd like to email us in advance, you can send one to sdteam@layton.com, and you'll get access to the strategic team and also to Sunday. So thank you so much, Sunday, for your beautiful presentation. I hope everybody enjoyed it. We do have a few minutes left for questions. If we want to open it up to a Q&A, I think we'd be very happy to do that.
All right, let me jump in here real quick. Looks like there are a couple questions that came in. Kathy was asking, is there any prohibition on contingent fees in tax matters?
From the sales and use tax side, no, that's something that Layton is able to do the reverse sales and use tax audit on a contingency fee basis. The only limitation would be our general consulting, or if we represented in a sales tax audit, then we would have to use an hourly rate there. But for the reverse sales and use tax process, we're able to do that 100% contingent fee.
And we're not subject to that because we are a consulting firm. So we file the taxes. We would rely on our partners like yourselves, CPA firms, to actually do the filing, but we prepare everything. We'll prepare the pro forma, which is why we can charge the percentage base.
Thank you. And then Daryl was asking, do you take any percentage of prospective savings?
So our fee is based off of the savings that we identify. So and we charge 60 days after we deliver everything. So it's not off of, I guess, prospective savings.
Yes, Patty, I think that's a key point to realize, is that there's no invoicing, nothing that the client would be due until they actually have received that benefit back from the state, either in the form of an actual refund or a credit on their account. That's when we would invoice after that time.
Great. And Cheryl said, we have found that some states come back with an aggressive audit after filing for refunds. Have you seen anything like this?
I haven't dealt with that too many times in my particular career. Generally, if that happens, it's with a client that is kind of aware that they have some exposure anyway. And so it's a great time to clean things up. But I don't really see this as creating a huge risk for an audit opportunity, especially when we're identifying things that are on the purchasing side truly exempt, or that truly the tax is overpaid and we have good documentation supporting that. That's certainly a conversation we have with the client throughout the process. If we notice in particular, wait a minute, we're seeing some exposure here, how should we move forward with this? Those are all careful considerations that we look at in order to mitigate the possibility of having an audit afterwards.
Great. And is there any risk of a reverse sales tax audit claim being submitted to the state, triggering a full sales tax audit by state auditors?
There's always a small risk of that, but generally when you have a very clean claim that's submitted and you have excellent supporting documentation, you already have your particular processes and everything taken care of, then it shouldn't usually be a huge problem, and you should be able to produce the correct documentation with your client in order to go through that process. But there's a small risk, but it's generally not something that's an automatic thing that's triggered.
Great. And Kathy was wondering, how do you promote or advertise these services?
Maggie, I'll let you take that one.
Sure. So we these are reflected on our website, and then we don't do much direct advertising. We do a lot of our business partnership and through referral-based business through CPA. We do have a team of business development executives who do direct outreach to clients. But other than that, it is really based through our CPA partners.
All right, thank you. And do you use sampling in your reverse audit approach? Are you analyzing specific general ledger activity, or are you reviewing 100% of 1 year of activity?
So we do use a sampling approach when it comes to pulling the actual invoice documentation. But one thing that Layton does that is not necessarily entirely unique to us, but I think is the most thorough way to do it, is we do a manual review of all the transaction detail from all the expense accounts during the look back period, which again is generally either 3 to 4 years, depending on what the state statute of limitation is. We'll look at the transaction detail of every expense account, but in order to keep it from being a huge burden on the client, we'll ask for a sampling of invoices from their most common vendors where we've seen these sales tax errors happening over the years, and use that as a starting point with the state. Now that said, there's always a risk that a state could come back and say, oh, produce every invoice. But in my experience working with the states, invoice sampling at that point is generally an acceptable way to do it, as long as you can show consistency throughout the audit period. And that's because states have limitations on the amount of data that they want to go through. And in terms of especially voluminous small dollar transactions where there may have been issues, it's just a lot of data for them to handle. Sometimes it's difficult for their portals that they require you to use to handle it. So the short answer is, yes, we review transactional detail in its entirety, but in terms of putting together the claim and pulling the actual invoices to support that claim, we will start with the sampling of the vendors throughout the audit period. And then if we need to pull additional documentation, that's obviously something we could certainly do and work with the client to get.
Fantastic. And we got a final question here asking, do you handle appeals?
After a sales tax audit, yes, so we can follow an appeal through the state taxing authority's appeals process. Once it has to leave the state taxing authority and go to a court, then it would need to go to a law firm. But I am authorized to, as a person with a P10 number and as an attorney, I can generally represent most clients on their audit appeals throughout the state taxing authority's process until it would actually go to a court. So at the administrative level, yes, we can absolutely handle.
Fantastic. Well, I think that is all the questions we have so far. So if any of you have any closing remarks, I'll close this out here.
Thank you all for spending so much time with us today.
And we just put a link in the group chat if you guys wanted to schedule time to learn more and ask any questions that perhaps you didn't have a chance to ask today. So click that link and it'll allow you to schedule with our expert team.
Fantastic. Well, thank you, Maggie and Sunday, for a great presentation and sharing your time and expertise with everyone today. And a big thank you to TriNet for sponsoring today's webinar as well. And as a reminder for our attendees, we at CPA Academy will be processing your CPE credit within 24 hours. We're also going to send you a recording of this webinar and a copy of the handouts. We have already sent you an evaluation form for this webinar, which is waiting for you in your inbox, as well as your CPA Academy accounts. So please take a few minutes to fill that out with your comments and feedback. We would love to know how your experience was today. All of these important items can be found in your CPA Academy accounts. Thank you again to Maggie, Sunday, and everyone at TriNet, and thank you to all of you for attending today. Make sure you check out our calendar on cpaacademy.org, and we hope to see you all on future webinars. Thanks for joining us today.
Bye. Thank you, guys.